17 finance ministers of the Eurozone once again have a very big problem, the Greek debt crisis that they thought they'd fixed a year ago with a very big bailout.
I have decided to hold an extra meeting of the Eurogroup for Sunday the 3rd of July, which presupposes that between now and then the Greek authorities, both government and parliamentary, will have done all they can to allow us to take our decisions on a solid basis.
They've decided to hold back the latest $17 billion slice of that bailout until Greece approves a fresh set of reforms and privatisations. It's a hollow challenge delivered with fingers crossed. Eurozone finance ministers are faced with a dilemma. It's clear Greece is sucking up good money after bad. For all the billions, its problems only seem to be getting bigger. But it's also clear that a Greek default would be far worse for the Euro club than it would be for Greece itself. To prevent it requires far more money for far longer. The existing bailout is fast becoming a sideshow. It's just not working. Opposition on the streets of Greece and political discord have sent borrowing rates soaring. So the discussions now are of a brand new bailout, billions more thrown at the problem.
We also made progress on the discussion on the content and conditions of a next step for Greece and the nature of private sector involvement.
Negotiators will try to encourage private investors, the big banks that hold Greek debt, to shoulder some of the burden. A Greek default, after all, could trigger another global banking crisis. In the end, though, the financial markets will decide. If the economy recovers, in time they might offer Greece affordable borrowing again. But the fear is they'll decide instead that Greece is beyond help, forcing a default, and so too others like Ireland and Portugal, maybe even Spain, putting in question the future of the Eurozone as a whole. Jonah, Al Jazeera, Luxembourg.